All right, let me start with the first point on the toolkit that the PBOC has at its disposal. We saw a very restrained PBOC in March. Actually, it was a little bit disappointing for the market, as most global investors are reading the tea leaves, trying to gauge the timing for this stimulus. But we are expecting to see more of it come through in April as a result of the weak PMI data. Specifically, we think they'll do one more round of interest rate cuts in April, 10 basis points. As we head into Q2 and weakness continues, it is possible that we will see 50 to 100 basis points in RRR cuts. And of course, PBOC can also use monetary aggregates. That means they will increase the pace at which they create money, so M2 growth, and also credit, to make sure that conditions are sustainable in the remainder of the year, to make sure that they can not only avoid a harsh landing, but also engineer that recovery and activity that we expect for the second half. PBOC and the Fed, we are seeing a general trend towards further tightening in the region this year as a result of faster than expected pace of Fed rate hikes in 2022. But there are two notable exceptions, Bank of Japan, and we've seen that sort of impact, especially on the Japanese yen front, and the PBOC, and we have not yet seen the impact on the currency front in China. But we do not think that the PBOC will adhere to the Fed this time around, because they have that very ambitious growth target to meet by the end of the year. So if they fail to implement another round of rate cuts in April, unfortunately, that is bad news, because that 5.5% would become very difficult to achieve.
Carlos, Dan here in Abu Dhabi. When it comes to the fiscal and monetary response, clearly we'll have to wait and see what happens with the virus trajectory in places like Shanghai to get a better understanding of how policymakers might actually respond. What do you think static management means when it comes to managing the virus in Shanghai and elsewhere? This is a label that policymakers there are now using. What does it mean?
Mm-hmm. We are going to gradually witness a shift in narrative away from zero COVID and towards a more pragmatic approach. And there is already evidence of this taking place a couple of weeks ago, when the government decided to adjust its COVID guidelines to reduce the quarantine days for infected patients from 21 to 7, but also increase the number of tools that they have to treat COVID, including Pfizer's own Paxlovid drug. This to me suggests that they are moving in a direction that is more flexible and more accommodating of COVID-19. But of course, they will only do this very gradually and in a way that doesn't jeopardize political stability in 2022, given that this is a very sensitive year. In that context, we do expect that they will remain very inflexible, or more inflexible, in the first half of the year. And of course, that will have repercussions on our GDP forecast for the second quarter. We are going to revise it downwards as a result, but they will start to become more flexible in the second half. So for global investors looking to time their re-entry, unfortunately, we do expect to see a little bit more downside pressure before all of this monetary and fiscal stimulus kicks in more robustly in the second half to make sure that they hit that 5.5% growth target by year end.